The Federal Reserve System is not owned by anyone. The Federal Reserve was created in 1913 by the Federal Reserve Act to serve as the nation's central bank. The Board of Governors in Washington, D.C. is an agency of the federal government and reports to and is directly accountable to the Congress. So in this video, we are going to discuss who owns the Federal Reserve and how it works. Now before we get into this video, make sure to hit that subscribe button and leave a comment below saying I subscribed. I will try my best to reply to as many comments as possible. The Federal Reserve System, often shortened to the Federal Reserve or simply the Fed, is the central banking system of the United States. It was created on December 23, 1913, with the enactment of the Federal Reserve Act after a series of financial panics, particularly the Panic of 1907, led to the desire for central control of the monetary system in order to alleviate financial crisis. Over the years, events such as the Great Depression in the 1930s and the Great Recession during the 2000s have led to the expansion of the roles and responsibilities of the Federal Reserve System. Congress established three key objectives for monetary policy in the Federal Reserve Act: maximizing employment, stabilizing prices, and moderating long-term interest rates. The first two objectives are sometimes referred to as the Federal Reserve's dual mandate. Its duties have expanded over the years and currently also include supervising and regulating banks, maintaining the stability of the financial system, and providing financial services to depository institutions, the U.S. government, and foreign official institutions. The Fed also conducts research into the economy and provides numerous publications, such as the Beige Book and the FRED database. The Federal Reserve System is composed of several layers. It is governed by the presidentially appointed Board of Governors, or Federal Reserve Board, FRB. 12 regional Federal Reserve banks, located in cities throughout the nation, regulate and oversee privately owned commercial banks. Nationally chartered commercial banks are required to hold stock in and can elect some board members of the Federal Reserve Bank of their region. The Federal Open Market Committee sets monetary policy. It consists of all 7 members of the Board of Governors and the 12 regional Federal Reserve Bank presidents, though only 5 bank presidents vote at a time: the president of the New York Fed and 4 others who rotate through one-year voting terms. There are also various advisory councils. It has a structure unique among central banks and is also unusual in that the United States Department of the Treasury, an entity outside of the central bank, prints the currency used. The federal government sets the salaries of the board's 7 governors, and it receives all the system's annual profits after dividends on member banks' capital investments are paid and an account surplus is maintained. In 2015, the Federal Reserve earned a net income of $100.2 billion and transferred $97.7 billion to the U.S. Treasury, and 2020 earnings were approximately $88.6 billion, with remittances to the U.S. Treasury of $86.9 billion. Although an instrument of the U.S. government, the Federal Reserve System considers itself an independent central bank because its monetary policy decisions do not have to be approved by the president or by anyone else in the executive or legislative branches of government. It does not receive funding appropriated by Congress, and the terms of the members of the Board of Governors span multiple presidential and congressional terms. Central Bank. In its role as the central bank of the United States, the Fed serves as a banker's bank and as the government's bank. As the banker's bank, it helps to assure the safety and efficiency of the payment system. As the government's bank or fiscal agent, the Fed processes a variety of financial transactions involving trillions of dollars. Just as an individual might keep an account at a bank, the U.S. Treasury keeps a checking account with the Federal Reserve, through which incoming federal tax deposits and outgoing government payments are handled. As part of this service relationship, the Fed sells and redeems U.S. government securities, such as savings bonds and treasury bills, notes, and bonds. It also issues the nation's coin and paper currency. The U.S. Treasury, through its Bureau of the Mint and Bureau of Engraving and Printing, actually produces the nation's cash supply and, in effect, sells the paper currency to the Federal Reserve banks at manufacturing cost and the coins at face value. The Federal Reserve banks then distribute it to other financial institutions in various ways. During the fiscal year 2020, the Bureau of Engraving and Printing delivered 57.95 billion notes at an average cost of 7.4 cents per note. Federal funds. Federal funds are the reserve balances, also called Federal Reserve deposits, that private banks keep at their local Federal Reserve Bank. These balances are the namesake reserves of the Federal Reserve System. The purpose of keeping funds at a Federal Reserve Bank is to have a mechanism for private banks to lend funds to one another. This market for funds plays an important role in the Federal Reserve System, as it is what inspired the name of the system, and it is what is used as the basis for monetary policy. Monetary policy is put into effect partly by influencing how much interest the private banks charge each other for the lending of these funds. Bank regulation. The Federal Reserve regulates private banks. The system was designed out of a compromise between the competing philosophies of privatization and government regulation. In 2006, Donald Cohn, vice chairman of the Board of Governors, summarized the history of this compromise. Agrarian and progressive interests, led by William Jennings Bryan, favored a central bank under public, rather than banker, control. But the vast majority of the nation's bankers, concerned about government intervention in the banking business, opposed a central bank structure directed by political appointees. The legislation that Congress ultimately adopted in 1913 reflected a hard-fought battle to balance these two competing views and created the hybrid public-private, centralized-decentralized structure that we have today. The balance between private interests and government can also be seen in the structure of the system. Private banks elect members of the Board of Directors at the regional Federal Reserve Bank, while the members of the Board of Governors are selected by the President of the United States and confirmed by the Senate. Government regulation and supervision. Ben Bernanke, lower right, former chairman of the Federal Reserve Board of Governors, at a House Financial Services Committee hearing on February 10, 2009. Members of the board frequently testify before congressional committees, such as this one. The Senate equivalent of the House Financial Services Committee is the Senate Committee on Banking, Housing, and Urban Affairs. The Federal Banking Agency Audit Act, enacted in 1978 as Public Law 95-320 and 31 U.S.C. Section 714, establish that the Board of Governors of the Federal Reserve System and the Federal Reserve Banks may be audited by the Government Accountability Office, GAO. The Board of Governors in the Federal Reserve System has a number of supervisory and regulatory responsibilities in the U.S. banking system, but not complete responsibility. A general description of the types of regulation and supervision involved in the U.S. banking system is given by the Federal Reserve. The board also plays a major role in the supervision and regulation of the U.S. banking system. It has supervisory responsibilities for state-chartered banks that are members of the Federal Reserve System, bank holding companies, companies that control banks, the foreign activities of member banks, the U.S. activities of foreign banks, and EDGE Act, and agreement corporations, limited purpose institutions that engage in a foreign banking business. The board, and under delegated authority, the Federal Reserve Banks supervise approximately 900 state member banks and 5,000 bank holding companies. Other federal agencies also serve as the primary federal supervisors of commercial banks. The Office of the Comptroller of the Currency supervises national banks, and the Federal Deposit Insurance Corporation supervises state banks that are not members of the Federal Reserve System. Some regulations issued by the board apply to the entire banking industry, whereas others apply only to member banks, that is, state banks that have chosen to join the Federal Reserve System, and national banks, which by law must be members of the system. The board also issues regulations to carry out major federal laws governing consumer credit protection, such as the Truth in Lending, Equal Credit Opportunity, and Home Mortgage Disclosure Acts. Many of these consumer protection regulations apply to various lenders outside the banking industry, as well as to banks. Members of the Board of Governors are in continual contact with other policymakers in government. They frequently testify before congressional committees on the economy, monetary policy, banking supervision and regulation, consumer credit protection, financial markets, and other matters. The board has regular contact with members of the President's Council of Economic Advisors and other key economic officials. The chair also meets from time to time with the President of the United States and has regular meetings with the Secretary of the Treasury. The chair has formal responsibilities in the international arena as well. Let us know your opinion in the comments section below. This was all for today. Hope you liked the video. Subscribe to our channel and stay tuned for more interesting videos. Stay safe, and we will be back soon with another video.